connect with Sailesh Raj Bhan. He is the CIO-Equity Investments at Nippon India Mutual Fund. Thank you so much for taking time out. Now, to begin with, Mr. Bhan, given the fact that we've been bombarded with a slew of headlines from across the globe, you had the fall of the major banks and the rescue steps coming in. In light of that, the markets have definitely borne the brunt of it back home. While there may not be any correlation with the Indian banking system, as a whole, how are you looking at our markets shaping up in light of this kind of volatility and news headlines?
Yeah, hi, good morning. Like you said, global challenges have been now continuing for nearly about 18, 19 months, with the start of the war and, the high inflation and interest rates. I think these are all, what's happening today is more a function of how the underlying conditions shifted maybe 18 months back. And that is what is getting reflected, or the outcome of that is getting visible to you in the increased volatility today, market adjusting to a normal world versus how the market used to be earlier in terms of looking at extremely low interest rates as a base case forever. So I think we are in that adjustment phase, and this is certainly hitting global demand. This is certainly hitting the growth outlook for Indian companies. In fact, if you look at what's happened in the last, 2 to 3 quarters in India, earnings have been fairly muted. In fact, we have been trending late single-digit earnings kind of growth, against generally trying to do 13-15%, which India has the potential to deliver. So I think we are already facing the impact of it. And I think some cases it's a function of, today we are in the midst of bad news, which is in a way now starting to give attractive prices for Indian equities. In fact, last 3 months have seen many, at least outside index companies, correcting and becoming more attractive. So I think it's a journey where we are in an environment of low earnings, at least for a couple of quarters, even from India, and where the valuations generally stand. I think we could just middle around for a period of time till we come back to stronger earning growth path.
This is Anish also joining into the conversation. So what are you doing with the deployment plans at this point of time? Are you keeping your powder dry, increasing your cash levels to probably look at better entry opportunities, or let's say accumulating opportunities for some of your funds, or are you nibbling into the markets in select stocks?
Yeah. Interestingly, while the indices have remained flattish for 18 months, so they have seen some kind of time correction. Over the last 3 months, we are finding material price corrections also happening in many pockets of the market. So relative attractiveness is certainly emerging in some places where the fundamental news remains to be weak in terms of near-term earning growth. So I think those are giving us opportunities to shift our portfolio to businesses which are more sensibly valued. So our focus has now been buying growth companies which are available at sensible prices, and that's been our approach to manage risk as well. So end of the day, not overpaying for growth, choosing selective businesses which are now better priced in the market is where we are focused on deploying our capital. As a fund house, we generally don't take significant cash calls as per our own investment policy and framework. And our idea is to continuously keep scouting for good available investable businesses at reasonable prices from a 3-year horizon.
Fintech stocks, would you call them high growth businesses available at really ridiculous price points, or now they're also looking reasonable?
Yes, could you repeat the first part, the fintech businesses?
The consumer tech fintech stocks. I mean, these are high growth businesses. Since you said that you want to buy growth businesses at a reasonable price, where does the word value fit in for a Zomato or a Paytm, or for that matter, Nykaa?
Okay, so the question is more on the new age kind of businesses where you definitely don't have, really don't have any specific near-term cash flows and businesses which are strong. So the approach to this is very simple. Was if you are getting these businesses at a justifiable, reasonable valuation, even if you look 3-4 years out, giving a couple of years more for them to demonstrate the right profitability, that I think is, in some cases, might start getting interesting. Are they at throwaway valuations? No, I think very few businesses in the new age space are in throwaway valuations. And I think in the listed space, the valuations are much better than what they used to be a few months back, but I think they are not at throwaway valuations. The key point in these businesses is whether each of these businesses have a right to win. So if they have a right to win, we can pay a premium because we know there is longevity to do these businesses. And I think when you have that kind of a framework in play, I think these can be valued a little more higher than other businesses because they have a longevity of growth, and that is what is the premium we'll be willing to pay. But excessive froth and all that, which has evaporated or has gone away, I think it's still not in the value zone, as you might call it. But I think opportunities will emerge and are emerging continuously.
So what is cheap in this market? What is cheap and where growth could be more than the earnings average? Because ultimately you get a combination of cheap and a reasonable amount of growth, you will make decent compounding returns.
Yeah, so we look at sectors, where there is reasonable growth visibility. For example, banking. Right, banking is reasonably priced, right, with a strong or a good medium-term outlook. Because I think the perils of the past or the challenges of the past are behind, and we are now getting into demand for credit and a reasonable environment for growth. It's not cheap, but it's actually maybe reasonably priced businesses with strong visibility. Similarly, pharmaceuticals. Now they are very reasonably priced. Secular nature of the businesses will start kicking in because all the ups and downs of COVID are behind, and hence at valuations which are 40-50% cheaper than consumer businesses, these appear very good opportunities to play in. Utilities, I think for the growth they are delivering or starting to deliver now are meaningfully attractive. So that's one more space which is there. One space where valuations may not be attractive, but growth outlook is very strong is the engineering and manufacturing, right? And their corrections of these kinds and this kind of global bad news can allow for increasing exposure to those spaces. So these are the four spaces we find reasonably attractive from a 3-5 year investment horizon, and that is where our focus today is in selecting businesses. Plus, outside these four spaces, you're getting a lot of businesses seeing meaningful corrections in the last 3 months. So it's just possibly people giving up on the high growth rate expectations of those businesses. There are certain ignored sectors like insurance and all which have suffered some challenge because of what's happened in the budget and the high valuations of the last 3-4 years coming off a bit. I think directionally those businesses are getting attractive from a medium-term kind of horizon. So I think it's a mixture of moderate growth outlook for businesses coming at reasonable prices. It's not still very cheap prices for most of the businesses.
So is the valuation now reasonable or attractive for the IT counters as well? Because growth is something which is definitely slowing. There is then the entire BFSI pressure plus the changes of leadership. How does the IT sector stack in your assessment of valuation versus growth?
There is still some time correction possible in these businesses because general growth rates have been coming off or likely to come off meaningfully because the main markets are just entering the challenging phase, which is US and European markets. So I think for this sector, even though valuations seem to have corrected, the earning uncertainty still remains. If these businesses are back to 8-10% earning growth, I think the current 20 multiples may not be sustainable for a lot of these businesses. So I think, as we have seen in the past, multiples do correct significantly when growth evaporates. And I think directionally, if you are looking at single-digit earning growth for these businesses, you may still have some time for these sectors to be becoming very attractive from an investment point of view.
The years you've really, in a sense, identified pharma. You've owned stocks like DVs, then MNC pharma names. What's gone wrong there? One company after another company either is getting hit because of US FDA or pricing power or both. And it's not only just US based companies. With the exception of few domestic companies, the entire sector per se now is going through a tough time. Sailesh, pharmaceuticals. I think we've lost him there. Bad audio. Just a bad audio. Doesn't matter. We'll try and get that connection, established with Sailesh Bhan. He's bought a lot of pharma stocks. I mean, I've tracked his funds for years now. He's bought into DVs. He's bought into MNC pharmas. They were those stable businesses which are growing at 15-20%. So let's see if we can get the connection back with him. Do we have him back? Okay, I think I'm just going to mark the markets and there you go. I mean, what do we have? On a day when Credit Suisse was bought over by UBS and the biggest concern in the European financial market has got addressed, there is just no strong price action in any of the major indices. All sectors, and I can literally tell you that with the exception of HPCL and BPCL, which is largely going up because of oil prices, everything is trading with a negative bias. Sailesh, you've bought pharma stocks in the past, names like DVs, MNC Pharma, but now turn by turn, every pharma company is having a challenge. Product challenge, pipeline challenge, US FDA challenge, pricing challenge. What's gone wrong for that sector?
I think interestingly, this has also gone through a cycle. You know, what you have seen of a very sharp rebound post-COVID. I think that has come off a bit, and I think we are now back to very normal stocking of inventory, normal business environment for these companies. Now, you mentioned about 3 or 4 challenges. I think the biggest challenge has been the expensive valuations in select pockets of pharma space. You know, where stocks went up 3-4 times in a very short period of time, because of COVID-led products driving or expected to drive their substantial growth. I think those corrections have happened. If you look at a normalized business conditions, most of these companies on core earnings are still growing 10-12%. It's just that they had a bump up of profits coming from COVID, which have driven very significant re-rating for select businesses, and they have now normalized for growth. Second is area where the challenge, which is real, has been the US pricing environment. I think US market has suffered on a profitability point of view fairly significantly. And we have seen price erosions continue there despite already lower prices and due to high competitive intensity. I think that phase still continues, and US market attractiveness remains fairly modest. But the core for pharma, which is the branded domestic space, remains as strong as ever. We are seeing meaningful increase in diagnosis, hopefully shifting to greater compliance, and also the opportunity here for getting new patients into treatment and giving them solutions, I think is very, very significant. The domestic branded space has still meaningful decades-long growth opportunity which exists, and that is where I think our focus should be, and our focus is towards, because these are branded businesses. Virtually leaderships don't change here very easily in terms of the categories and the products people operate in, and the chronic market play of India continues to support growth in a lot of these branded Indian pharmaceutical businesses.
All right, we'll let you go on that note. Appreciate your time. Thank you so much for joining in and giving us a view on what the construct of the portfolio should be, as well as your outlook on the markets.